Hey guys, welcome to Make Money Count. I'm here with my friend Marcus. It's been a few episodes since I've been here.
Hello, friend.
Hello. And I'm very happy to be back. Very happy.
And it's great to have you back.
Yes. Great to have you.
So last couple episodes of Make Money Count, I have been talking about probabilities of interest rates dropping, how bond yields are changing, how the economy has been reacting to what's happening. We spoke a little bit about the government of Canada's push to create more housing and whether that is necessary. So today we'll talk a little bit about the economy.
Mm-hmm.
And then I want to get your perspective kind of on, first of all, what are rates doing?
Right.
What are rates for customers? What are those doing?
Mm-hmm.
What's the best product to take right now?
Mm-hmm.
And what are some of the challenges we're seeing in the market for a consumer looking for a mortgage?
Mm-hmm.
And how are you able to overcome that?
Absolutely.
So I want to start off because I think it's important. The economy is not doing well.
Right.
Can you feel that?
I mean, I was out at a packed restaurant yesterday, but
Oh, really?
yeah, but and the Sherway Mall was packed, which is weird.
Yeah.
But in other areas, I can definitely feel it.
So consumer confidence keeps dropping.
Mm-hmm.
We had one reading last month that was like a slight uptick, but I think on a trend, we're seeing it erode. But the real estate market is seeing softening. So we're seeing now sales have dropped last month and active listings have increased by almost 50%, which is a really big number. And over the last quarter or so, we're seeing the market, the real estate market, really soften. And the unfortunate thing for our economy is that Canada has become a bit of a one-trick pony with real estate, right? It contributes so much to our employment, so much to our GDP, that when it softens, we feel it. Our economy has really lost its mojo. We're not productive anymore. We're not productive relative to our peers. And when a country's productivity slips, you can only hide it so long with kind of artificial population growth, right? Like open up the floodgates, bring in a whole bunch of immigration, hope that the immigration covers over the lack of economic growth that the country can actually experience.
Right. Can I ask you a question while you're on this? When you say productivity, do you literally just mean like how much a person works?
Not works, but how much they produce.
Contribute.
Yeah. So like amount of GDP output per worker.
Right.
Right. So you bring in more workers, but you can't make more money.
Right.
Right. And you can think of it on like a macro scale. So of a country. And you can think of it on a more micro scale of a company. So if you had a factory and you made widgets and you had an assembly line that made widgets and that assembly line had its peak efficiency would have 50 people working on that assembly line and you need to make more widgets. If you hired another 50 people and put them on that assembly line, you wouldn't double the productivity of widgets.
Right.
You need another assembly line, infrastructure. And the problem that Canada is faced with is that we have not been investing in infrastructure. And when you don't invest in infrastructure, you can't give the opportunity to your workers to be productive.
Right.
And infrastructure in our case means like everything from a road to investment in education, to investment in hospitals, to investment in open banking, to investments in technology businesses to support them. We're going in the opposite direction, right? We're kind of going in this mode of taxation to slow down those industries and to provide perhaps some justification to allow the government to manage more money to redistribute as they see fit. And that brings me to a really good point. Right now, the government sees it fit to distribute oodles and oodles of money into housing, right? Because they think there's a problem in housing.
Right.
I think the next slap in the face we're going to get is that we're going to find out that we don't really have a housing crisis. We don't have a housing shortage. And we're seeing signs of that already, in that the rental market is weakening. Right. Prices for rent are dropping now. They're below where they were last year. And housing is coming online at a really rapid rate. And it's all a factor of interest rates.
Right.
So interest rates have been high for a long period of time. And as a result, the economy has slowed, and fewer people are going to want to rent an expensive apartment by themselves if unemployment has increased, if the economy has slowed down. So you'll naturally see more come online. And by a factor of just the way construction works, stuff came online, right? Like we saw 44,000 units come online of housing. And now those units of housing need to be occupied. And as builders and large scale apartment rental companies and investors that bought condos look to occupy those units, they're looking to a pool of people that is decreasing.
Right.
All the immigration that we incited in our country is not proving to hold up those levels of required housing. But the Canadian government is chasing that still.
Right.
So they're going to spend a whole bunch of your money to chase that housing affordability right now. And I suspect the next story will be in 6 to 12 months that, oh, geez, we're so successful at solving this housing crisis, when in actual fact, the housing crisis solved itself because we killed the economy with high interest rates.
Right. I mean, that's like the buzzword, right? Like whenever you're looking at, any of these politicians' Instagram pages or see them on TV or whatever, they're always just talking about housing.
Yeah. If you take housing out of the equation, we have no inflation problem. Our economy is, growing. Inflation's at like 1.5%. If you strip out all the housing related CPI inputs, that's a problem. Right. Especially it's a problem, especially for a Bank of Canada that wants a 2% target. I don't know if that results in a rate cut in June, but we're seeing it in bond yields. We're seeing it in CDOR TMX predictions. We're going to start seeing more economists and more market dealers skewed to the side of lower future rates. The only thing that may be holding us back right now is the United States, right? We talk about that all the time.
Yeah.
There's this idea of a divergence between Canada and the United States. And oh no, it will be so bad when Canada has to drop interest rates and the United States doesn't, because their economy is doing great and our economy is doing shit, right? And I hate swearing on this, but like we're going to at some point diverge. We have to. Number one reason why: the Americans are more productive than us.
Right.
The Canadians are not as productive as our neighbors to the United States. In order to adjust that productivity imbalance, we probably should have a dollar that's weaker, which means that the result of rate cuts in Canada and a Fed that will hold firm is probably, which is a lower Canadian dollar, is probably justifiable in this market. So I know because we talk all the time. I know that this is manifesting itself now in the mortgage market.
100%.
Right? And I know how great some of the rates are. They're going to get better. And that's what I wanted to talk to you about, right? So like we've got this situation where productivity sucks. Housing is continuing to weaken, like almost 50% new active listings in a month. It's crazy.
Yeah. And in the spring market too. Like,
yeah, I predict we're not going to see much of a spring market.
Right.
I hope that we can see something of a fall market. But again, when you leave interest rates high for a long period of time, just reducing interest rates may not be enough to restart a market. And the housing market is so dependent upon for Canadian GDP that it has already been hurt so much. I don't know if it's going to come back the way people anticipate it to come back. I think that having rates for so high for so long have impacted other parts of our economy. Unemployment going up is one critical piece. A lack of the type of new immigrant input labor that we need in the country is a problem. But I think the bigger problem is, you know what? It'd be great. We could allow everybody to come into Canada, but we don't have the tools to make everybody productive.
Right.
Right. We are bringing people in and we don't have the right tools to empower them to help us grow the country.
Right.
Make the country better, make it more productive.
I have a buddy that's looking for a job right now. And he told me that like some of these jobs that he applied to, because you can see how many other applicants there are, there's like thousands of applicants applying for one job.
Yeah.
People are just desperate, right? It's crazy.
Yeah. I think it's going to get worse. Like we saw business insolvencies go up by like almost 90%.
Right.
Like that's a telltale sign that small and medium-sized businesses are getting hammered. Debt servicing costs are high. The consumer is weak. They can't sell their products for as much. We're going to very quickly turn from like this, like, oh my God, inflation. Oh my God, housing shortage to, oh boy, we're not productive. We don't have anything working in our economy right now. And then we're going to have to pivot. I don't know. Honestly, do you remember we did a show at the start of COVID? And I said, I wish at this moment right now, the federal government could get their act together and use this blank check that they've been afforded to invest in things that will make us productive.
Yeah.
You know, honestly, Austin, if you could find that clip from one of our previous shows and play it like now, would be great. But if at that moment we used just some of this money that we just fucking blew this money, like, and it wouldn't have taken much to apportion it into areas that would have helped us come out of this more productive. I don't think we should have spent any money. Right. And I didn't at the time either. Right. But if we could have directed it towards like healthcare and education and our technology industry to nurture companies that would help us become more productive.
I mean, we did spend some money on technology. We built the ArriveCan app.
That's right.
For like $25 million or something like that.
I think it was like 60.
I don't even know how much it was.
Listen, I don't want to become too jaded by all of this. Like we spent so much money, it went in the wrong spot. And when money gets spent the way it was spent, it's like, you know, Tinder for the economy. It just like flames it up, causes problems. And then in the end, you know what happens when you put too much Tinder on a fire? It suffocates the fire itself because there's so much ash in the fire, right?
Yeah.
So you need to find a way to get the fire to burn out through that. Yeah. We were outside earlier and we were talking. You noticed that there was like a little tree that was growing out of the side of the building. So like think of that like our economy, right? Our economy is going to be resilient, right? Warren Buffett always says this, right? He's like, you know what? I don't care. You know, when the American economy is down, I bet on it because there's no economy that's more resilient and more productive. And Canadian economy is like that, right? It's resilient. The people are productive. We've got the framework to build something amazing, but we keep letting politicians come in and like over the last 8 years, we've been led in a bad direction and we've accepted it. And now we have to accept where we are because of it. And we got to figure out a way to come out of it. And we got to find a way to come out of it stronger. And I think that, again, the path that we're going down is more knee-jerk reactions, right? So before we had a knee-jerk reaction to like, let's just blow a whole bunch of money because it's COVID. Now we got a knee-jerk reaction that's like, let's just blow a whole bunch of money because it's housing.
Right.
But it's not housing affordability. It's productivity that is our underlying problem. Productivity that will sink us, and productivity that will continue to erode and get worse and make us less competitive to our peers.
Yeah.
Okay, I already talked way too much about the economy. All of this nonsense in the economy, all of these inherent structural problems are resulting in the markets. So like the money market, the mortgage market, the bond market, they're now starting to make bets more heavily of a future with lower interest rates. And we're seeing that manifest itself in bond yields.
Mm-hmm.
We're seeing it manifest itself in the CDOR TMX predictions. And we are seeing it on a kind of fundamental micro level in our mortgage business.
Yeah, day to day.
And across Canada right now. So I think we have our 2 lowest interest rates in Canada. I know we've got the best rates on the market, but there's a reason for it.
Yeah.
And it's an attempt to like rescue this housing market, which has gone totally sideways.
Absolutely. Yeah. So, I mean, I was on one of our competitors' websites earlier, rhymes with Rate Hub. It's just Rate Hub. And their best rate, I mean, our best rate right now is 449, which is pretty crazy. We haven't seen rates that low in a long time. And comparatively speaking, Rate Hub is like 25 to 50 basis points higher on their website, which I'm not really sure why that is. We always have the best rates. They're usually a little bit better than the other guys.
But they're tighter then, usually. They're a little tighter.
Exactly. Yeah, 100%. It's quite polarized right now. And, you know, it's kind of crazy because for the last while, when I deal with my clients, I've been so surprised at how resilient our clients are for, you know, being able to keep up with their mortgage payments and requalifying and so on and so forth. But that's kind of coming to an end. I don't know if you kind of pictured that, but like it's coming to an end now where I'm having more conversations about people not qualifying for their mortgage. You know, they've racked up so much debt that they just can't get out of it. It's an unfortunate conversation that I have too much, but you know, there's definitely options, right? Depending on, you know, what kind of borrower you are, self-employed, or, you know, if you have a good job and fairly poor credit, like newly non-bankable, we like to call it. There's lots of options available.
I feel like in times like these, so like for sure, we have the 5-year fixed rate that we would have wished we had a year ago.
Yeah, definitely.
449. We know that there's an uninsured variable that's at prime minus 1%. Like, I mean, 1.01. Yeah. I mean, soon it'll be 1.05. Maybe by the time this pumps out, it'll be 1.1. That means, you know, prime's at 7.2. We're at like a 6.19% variable rate mortgage. I like that product. So like a 619 variable for an uninsured mortgage. What's the insured rate? Not that good,
1.25.
Right? Oh, it's way more.
On variable, yeah.
Okay, so 595?
Yeah, 595. Yeah.
Okay, so I like both those variable products. I like them for 2 reasons. Number one, you can see now this like kind of subpar spring market. The banks are trying to get business and they're out there with these really great 5-year fixed rates, right?
I was surprised by that prime minus 1.1. Very surprised.
Right.
Yeah.
And what's the best uninsured 5-year fixed rate?
4.79.
Okay. So you got 4.79 on the uninsured fixed versus 6.19.
Yeah, 6.1 if prime minus
6.1. Fine.
Yeah.
I still think now a variable is the way to go. I might even think it more forcibly because of what I see happening with the Bank of Canada. I think like we're, again, to the economy's detriment, we might not drop rates in June.
Right.
But we will in July. And then we will see a continued regime of rate cuts, which will leave people at least 1 percentage point lower on the prime rate within the next, I would say 12 months from today.
The other thing too is like taking a variable rate leaves you with that guarantee of a 3-month interest penalty, right?
Yeah.
So when
options.
if we do see, 2-3% fixed rates again, then, you're able to lock that in. If you take just to make
4.5%.
Yeah, 4.5%, and you break your mortgages 2.5% at that point, you're going to get eviscerated with penalties, right?
Yeah.
So, taking a variable rate gives you a ton of options in terms of being able to, lock into something in the future.
It's funny because we haven't spoken about interest rate differential penalties for so long because interest rates have been spiking up. But if you remember, interest rate differential is the ability for your lender, and the banks are notoriously tough on customers for this, which is another reason why the mortgage finance companies grew so much. Like the First Nationals of the world, the Merrickses of the world, they grew because they were so much more customer friendly, especially on those IRDs.
Yeah.
But the banks, when it comes to breaking those mortgages, if you were going to lock into a 5-year fixed rate right now and you got excited about a 449 or a 479, and you should rightfully get excited about them because we've got this, it's like we've been beaten for the last 2-3 years with these really high interest rates. So you kind of just jump on one of these 449s. The problem is when, not if, when rates drop back down and we see a 3% 5-year fixed rate, which we are very likely to see within the next 2 years, you will be faced with an interest rate differential penalty, which is the bank's ability to charge you the difference between the rate you're paying on your mortgage and the rate they can offer a consumer on a mortgage that equals the remaining maturity of your loan. So when, let's say you take a 5-year fixed rate today and you get it locked in at 4.5%, and 2 years from now, the 5-year fixed rate is 3%, and you want to jump to that 3% 5-year fixed rate, what they're going to offer you is a penalty, first and foremost.
Yeah.
And that penalty is going to be the difference between the rate they've given you and a 3-year rate, because you have 3 years left on your mortgage 2 years from now. And the 3-year rate, you better believe me, the 3-year rate, if the 5-year rate's 3%, the 3-year rate's going to be lower. Maybe it'll be 2.5%. And you'll be responsible for paying the difference between 4.5%, your contract rate, and 2.5%, the rate on a term matching the remaining maturity of your mortgage for the rest of those 3 years. That's 2% on your mortgage times 3. So on a $500,000 mortgage, that's $30,000.
Yeah.
Remember, those interest rate differential penalties were no joke.
Yeah, no.
Banks will always make money. I was speaking to somebody about this today in another vein, but they'll always make money. Like the deck is stacked in their favor. It's worse than a casino.
Yeah.
Because they own the casino, they're dealing, and they know which cards they're giving you. And they're betting against you. So like, that's why I've always been, and obviously for the last couple of years, like to my detriment, I've always been supportive of variable rate mortgages. And especially now, as we are coming into a period of what looks like lower interest rates from the Bank of Canada because of a poorly performing Canadian economy with some systemic issues that are going to take time, I'd advocate it for most of our customers because it gives the flexibility to jump out of the product, and it'll be kind of fun to have a variable rate mortgage right now as rates drop and you get a notification that your payment is coming down or you're paying more towards your principal. Like these would be kind of a bit of a silver lining in an otherwise pretty difficult time.
You'll definitely feel better about it now than you did a couple of years ago when it was going up. Yeah.
I think that the bigger problem now is qualifying people. So I think that like during this last period, rates were so high, our business was centered around getting people like any solution, like, a second mortgage, a B mortgage, self-employed borrowers trying to figure out how they could borrow money cheaper. Now the problem is affordability, but qualification.
Right.
And as underwriting guidelines continue to tighten into this market, consumers need more help. And if they're going directly to their bank for that help, again, it's not the place you go for help.
I mean, I've said it a million times and I'll say it a million times again.
A million?
Probably close to that anyways. But like, I always get the question, the biggest question sometimes people ask, especially if they've never spoken to a broker before, is like, why should I use a broker? Why should I use you? What makes you different, right? And like, the thing is banks, mortgage finance companies, monoline lenders, trust companies, all these people, all these different lenders have all these different ways to look at mortgages, right? And when you're talking about qualifying, if you go to your bank and they tell you that you don't qualify, well, it's just you've tried to fit yourself into one tiny little box. It's like that game where like there's all those different shapes and you have to put them all in before it explodes and shoots everywhere, right? I don't know what it's called, but
I don't know either. I think
but that's what we do, right? That's our job. And so, where you might not qualify somewhere, there might be tons of other options that you're not looking into, because your bank is a little tighter because, they were lower for longer and now their interest rates are high, whatever the case may be is, right? So
I think for sure we're entering into a period now where the consumer is going to need more help, and the banks are inherently, I want to say at a disadvantage to helping people, but the banks are built to help themselves. Canadians always will go to their bank first, it seems like whatever. We got like 30%,
most of them,
25 to 30% of Canadians will use a mortgage broker. When you go to your bank and you hear something that you don't like, sorry, we can't give you any more money on your mortgage. We can just give it to you on a line of credit. Or, yeah, we can't give you any better on the rate because we're having a hard time qualifying you. Or, no, I'm sorry, we can't approve you. Or, your ratios don't work. Don't take that as fact, right? Speak to a good mortgage broker. Doesn't have to be us, again, but we're entering into a time period where the consumer needs an advocate. The borrower needs an advocate, and they're not going to find that advocacy at the bank. The bank is advocating for themselves and how they can make the most money, right? We know that. Consumer needs to know that. The consumer needs to respond to that by trying to seek out more information. So even if you just use your mortgage broker to get that information, so you get the lay of the land, you should be doing that in this market.
Yeah.
And we saw it over COVID. We saw it after COVID. We're going to start seeing it even more. There are great rates available. There's great solutions available for people, but market's going to get tighter. Market's going to get tougher. You're going to have business for self borrowers whose businesses aren't doing as well now. And you're going to need to help those borrowers find a solution. You're going to have people with multiple properties, and they're going to be seeing those property values have dropped over the last little while.
And rental income coming down.
There's a lot of systemic problems. And I always recall this. There's the Bank of Canada report from like 20 years ago when I first started in this business that said that if Canadians want to have the best exposure to monetary policy, they should use a mortgage broker. Such a powerful report for the Bank of Canada to release. But what they were saying was monetary policy comes in the form of, in a time like this, comes in the form of rate cuts. And if you are dealing directly with your bank and only your bank, you will not have the same amount of exposure to those rate cuts, to that monetary policy loosening, as you would if you used a mortgage broker. Especially
when your bank has your checking account, your savings account, your credit card, your line of credit.
That's in the report.
Yeah, exactly.
It's actually in the report that the banks are less competitive to the consumers that have more products tied up with one bank because they realize how sticky that customer is. And I mean, sure, is there something sinister in it? Yeah, but like it's a capitalist environment, and it's also really tightly controlled and held with really strong lobbying and well-entrenched players. So you're going to have to expect that you need to get a little scrappy in order to extract the best deal for you, the best deal for your family and your finances, especially as we go into a period where we're going to see loosening in monetary policy in order to try to stimulate economic growth. And the worst thing you can do for yourself is like go in and just accept a really shitty 5-year fixed rate and rumble through with it, because I guarantee you within 2 or 3 years, you're going to break it. You're going to hand over 30 grand to the bank at a time when you can't afford to hand over $30,000 in after-tax money.
I used to have my mortgage with CIBC, and I once paid them back more than what I originally borrowed from them.
Yeah.
So like I borrowed 440 grand and I paid them back like 460 to pay out my mortgage.
Yeah,
It's insane.
The whole thing sucks.
Yeah. It's insane.
Right. Anything else?
I don't think so.
Thank you very much. This was a lot of fun. It was great to have you.
It was nice.
It's so much nicer when I have somebody to like chat with instead of sitting here droning on in front of the microphone the whole time. So we'll be back next week with one. Thank you. In the meantime, if you see this on YouTube, please hit subscribe to our channel. Please like the video, and please leave us some comments, because the comments that you leave us help give us ideas for our next shows.
Yeah, questions, all that stuff.
Thank you very much for joining us on another episode of Make Money Count.